The previous two videos you watched serve as a good transition between topic 4, which talked about journalizing, and now topic 5, which talks about posting to a ledger. So we look at information that goes from the first book of the business, the journal, into the second book of the business called the ledger. That process is called posting. The journal and the ledger serve different purposes for a business. The journal shows a chronological view of what happens with the business, a day-to-day look. The ledger, on the other hand, is not chronological, but it does show the different accounts, and it indicates the current balance of each account, as we'll see. So the two books do different things. But the key is getting the journal right to begin with. So topic 4 is pretty important, because if the journal entries are journalized incorrectly, then we'll see that the posting to the ledger will be incorrect as well. So it's important to get this correct in the journal first of all. So if you need to go back and review those previous videos, please do so, because the journalizing is so important. Let's look at how posting works. On the screen you see a general journal page, and now the pages are indicated in this and in future problems. This happens to be page 4 for the Halloween costume shop, and we see a few entries here. So when we post them, the process is really relatively simple, as we'll see. Let's go through a few. October 1, we have cash sales, and when we post it, we look at the first account indicated in the journal, and this is cash. We find it down below in the ledger, and you see the tabs down here: assets, liabilities, owner's equity, revenue, and expense corresponds to the accounts in the ledger. We know cash is an asset, so we go to the asset section, we find cash, and we begin to post. First of all, we put in the date, October 1, and this was a debit of $85. So if it was debited in the journal, it's debited in the ledger. This reference column now should indicate J4. So this now means that this entry, $85, came from journal page 4. We now take the account number. Cash is account number 101, and we put the 101 back in the reference column in the journal. So each journal has a reference column, and each of the accounts in the ledger has a reference column. We go to the next account, which is sales. Both of these accounts increase. We got more cash, and we made a sale, so that increases as well. Sales is a revenue account, which increases on the credit side. So we go to the revenue account, we find sales, and as we indicated earlier in an earlier video, sales and expense accounts at the beginning of an accounting period do not have a balance. Don't worry about why that is right now, and we'll explain that later. But at the beginning of an accounting period, they show a zero balance. But now on October 1, we made a sale, and that was $85. So that increases sales, which is credited. And again, in the reference column, J4. And this account number is 401. Sales typically begin with a 4, and the first one, in this case the only one in the revenue section, is sales, which is 401. We put 401 back into the journal. Now we have posted this transaction. Next one, electricity expense. Please remember that we use account names in the journal. So don't put electric bill here. The proper account name is electricity expense. It goes up because we paid more of this bill of $215. So we find the electricity expense account, obviously under expenses, and we put in the date, which is October 2nd, and the debit is $215, and again J4 comes from journal page 4. And expenses begin with a 5. electricity in this business is 501. So that's what goes back on the same line in the reference column, 501. Cash now goes down. We spent some money. We know that because we wrote a check. Cash decreases, so cash has to be credited. If it's credited in the journal, we credit in the ledger as well. So the date and the credit of 215 means cash went down. Again, this came from journal page 4. So you can see if you add up the debits, subtract the credit, you'll get the new balance for cash. Cash, again, number is 101. That's what goes in the reference column. We bought office equipment on October 3rd, $10,000. Office equipment is an asset. It went up. We got more. It's something that we own. And we find office equipment over here. And we put in the date, October 3rd, and it's debited by 10,000. We gained more office equipment. And if we want to find out where it came from journal page 4. And this account number is 104. So that's what goes here. Cash, again, is credited. We spent some money. We didn't spend 10,000, but we spent part of it. And we have to find the cash account again. And it's credited by 2,000. Came from journal page 4. So you can see the cash account is used very often. 101, back in the journal. Accounts payable, we owe more money. Now that's a liability account. 8,000 is credited because we know that accounts payable increased. So we find accounts payable. We see that there was a balance to begin with here. We owed money as of September 30th. Now we're going to owe more money. We're going to owe 8,000 more. So that'll be our new balance when we add those two numbers up. J4 is in the reference column. Accounts payable is 201. And that goes back in the journal. And two more quick ones. This time on October 4th, we paid a bill. We paid at least part of a bill. So accounts payable goes down. So if we look at accounts payable back in our liabilities here, accounts payable has to decrease. Liabilities decrease on the debit side. That is a debit, which means a decrease in accounts payable. We owe less. Again, the account number 201 goes here. So the previous transaction, we owed more money, we credited. This time we owe less money, we debit. And again, cash is credited as well. Cash goes down. We go back to our cash account, put in the date, and we paid more money out, 725, J4 in the reference column, and whoops, 101 in the journal. Last one, we received money from the customers, and that means we got more money, cash went up, so we debit 341. This time the date is October 5th, and we gained $341, so it has to be debited, which increases that asset account. Came from J4, and oops, there we go. 101 goes back into the journal, and accounts receivable goes down. Accounts receivable is an asset account, which shows how much people owe to us. This time somebody paid us money, so they owe us less. So 341 is credited. Again, accounts receivable is an asset. You see, as of as of September 30th, people owed us a total of $12,100, and now on the 5th of October, somebody paid us $341. This doesn't show us who it is. We'd have to go to a subsidiary ledger. We'll learn about that much later to find out exactly who that customer was. But somebody paid us $341, so they owe us less money. This came from J4, and this account is 102. And so we go to the journal and put in 102. So that's the process. Not really that difficult. As I said, once you get these entries correct in the journal, then posting is relatively simple. It's a process that's the same every time. Whatever you do in the journal, you do in the ledger. So that's why the journal has to be correct, otherwise the ledger is incorrect. But this now shows us, for example, cash is used most often, and you know that debit side is the increased side, credit side is the decreased side. This doesn't show the balance, but if we add up all those numbers and we subtract all those numbers, we'll get a new balance. It'll still be a debit balance, but we'll have a different amount of money by the end of October the 5th. So that is the process of posting. So at this point, there are some questions that you need to find on your course page.